Welcome to Blind Squirrel Macro, the pod, the usual companion to our weekly newsletter. Hope you like the new music too. Squirrel is coming to you this morning of September the 17th, Melbourne time. Quick reminder to make sure that you get the show notes for charts and links. If you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. But before we start, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent, talk to a financial advisor. Now in Japanese, Doji quite literally means the same thing. In the world of technical analysis, a doji candle on a chart, created when the price of a security closes at the same level at which it opens, is viewed by market technicians as a sign that buyers and sellers are undecided as to the path forward. Now the squirrel finds himself in a doji candle frame of mind when it comes to both the economy and the markets right now. The so-called data-dependent Federal Reserve appears to be now resorting to managing market expectations via leaks to favoured Wall Street Journal reporters. Ironically, this has resulted in a perfect coin flip scenario as we entered the week yesterday. It looks a bit more like 50 basis points now, but it seems pretty clear that Chairman Powell doesn't wish to disappoint markets. This backdoor assurance could not have come at a more critical time for the semiconductor sector, arguably the beating heart of the AI rally of the past year and a bit. The sector is currently in a knife fight to hold on to its positive trend. Is that a lower high I see in semiconductors? Anyway, short-term interest rate futures continue to pencil in 4+ rate cuts by the year end. I still think that the market is getting way overexcited about fixed income. The squirrel's whiskers are sensing that some of these cuts need to be priced back out, and fast. Meanwhile, the Bank of Japan continues with hawkish messaging on rates, notwithstanding some emerging squeamishness from the political class over there in Tokyo. Yen appreciation is accelerating. However, breathless discussion of the yen carry trade unwind appears to have disappeared as quickly as it arrived. Momentum indicators would suggest that yen appreciation might soon pause for a breath. On one hand, the recent move appears to look like an overdue catch-up with yield differentials. But, we'll never know what they say about overstretched charts. But we should also never forget that yen adjustments have a history of violence. 1998 saw the yen appreciate by over 20% in less than 8 weeks. I put a good illustration of both of those things in the notes. The risk of a continued revaluation of the yen has implications for all risk assets. Not a mainstream dialogue yet, but I'm starting to see mentions of potential re-hedging flows around structured products, such as those infamous PRDCs, or power reverse dual currency notes. Don't those just sound toxic? It's giving this rodent some PTSD reminders of some of the great risk unwinds of the past. Japan is not referred to as the Saudi Arabia of savings for nothing. Bad things happen in risk markets when those savings decide that they need to go home. This places your favourite macro rodent in a dilemma. A weaker US dollar should benefit many of the trades and themes that I favour, and the mighty greenback certainly looks like it's trying to probe some new lows. Are we really entering in a market regime that will favour real assets? Last week's move in commodity futures certainly seems to suggest that this could be the case. These assets tend to have a vocal fan base, and the excitement appears to be brewing. No shade on the commodity boys, but their glee makes me a little bit nervous. To be fair, while pretending to be highly objective here, the squirrel must confess to being pretty biased in that department too. Incidentally, I have a new favourite website, uonia.world. It celebrates words in over 80 languages that do not easily translate from the native tongue. My word for today is kuntsukuroi. This Japanese word translates as follows: to repair with gold, understanding that a piece is more beautiful for having been broken and repaired. Well, for much of the past couple of years, it's commodity investors that have been broken. However, is the barely discussed advance in the price of gold a harbinger of a more broad-based move up in real assets, or just as my new friend JJ Alyosha describes, a function of an Eastern Hemisphere buyer base that cares more about quantity than price? In the past few months, we're finally seeing signs of a catch-up move by the yellow feather's second derivatives, namely silver, and more recently the platinum group metals, and of course the gold and silver miners. Although might the latest move by the miners be simply a function of the fact that the M&A departments of the Canadian broker-dealers are finally beginning to see some action. Of course, with falling energy prices, miner earnings have been inflecting higher for months, yet mainstream institutional money has not cared one jot. The recent takeover of Cisco is a case in point. I posted a brutal tweet in the note that says it all. It reads as follows: a Cisco group did the impossible, consolidated the land package, drilled the discovery hole, proved out a Tier 1 deposit in a Tier 1 jurisdiction, and sold out to a major at an all-time highs of $2,500 per ounce in the gold price. And then you look at the chart, and the little takeover premium looks like a pimple compared to the 10-year price chart. Is that really a premium that rewards 10 years long slog of investment? Mining really is a very tough investment category, particularly in the precious metals. But it's not just there. Based on the shares outstanding of XME, which is the broad-based iShares Metals and Mining ETF, investors have been fleeing from the sector in their droves since the Ukraine invasion highs. Yet last week, the mining stocks were running like they'd stolen something. The squirrel does confess to have found himself getting quite excited about these moves last week. This week I was even on the verge of writing up an opportunity in selected oil and gas producers, a market that I've barely touched for nearly 2 years. I walked myself back from the ledge, for now. I do, however, believe that in this latest breakout in the gold price, precious metals are already an overweight position for the squirrel. However, I restrict myself for the time being last week to just writing a few gold puts and a few put spreads. Russell Clark always reminds us that we should not forget what gold is. It's in essence an Asian asset that just happens to trade in the West. And on that note, it's important to note that gold in yen terms is almost 15% below its recent highs. Incidentally, Chinese and Indian buyers have also enjoyed excellent performance over the past 2 years, but with a much reduced positive rate of change in the past few months and weeks. Now, it always seems like the world and his wife would love to add to their gold positions a few $100 an ounce lower. This usually means that it never gets there. However, if the yen carry trade unwind headlines have indeed subsided prematurely, let's not forget that, at least most of the time, gold is a risk asset too. With coin toss setups for this week's Federal Reserve meeting, well, not quite now, and of course it certainly still is for November's US elections, the squirrel is going to exercise restraint in strapping on more risk in assets that hurt when you drop them on your foot. In fact, we're going the other way. Inside Baseball with Old Chestnuts, legendary Morris Sachs always discusses the importance of periodically getting out the trusty yellow legal pad, if you know you know, and going through the process of re-underwriting all of your existing positions. In section 2 of this week's letter, we did just that. We covered it all, from our new Asian stock ideas to our current fixed income views via luxury baskets, agribusiness, Formula One, healthcare, tyres, US refiners, UK midcaps, drill ships, nukes, as well as some US technology and utility shorts. Well, this month, the Squirrel Pod hit a bit of a milestone. After a year of publishing it, over 1,000 of you are listening each week. Thank you. To celebrate, the branding team at Team Squirrel insisted that I commission a new theme tune for the show, which is what you heard at the beginning. It was created by talented local composer and saxophonist Max Slorak. You can find his details in the show notes, and I hope you like it. I think it catches the vibe of your favourite snarky rodent rather well. Get more of that snark at blindsquirrelmacro.com or find me on Twitter at squirrelmacro. Thank you again for listening. Squirrel out.